Today, we're doing a fascinating deep dive into what's been happening with the economy and the markets recently. We're drawing on a pretty comprehensive market outlook document for the week ending June 30th.
Yeah, our goal here is to really cut through all the noise for you. We want to highlight the key trends, give you a solid grasp of, what's been going on and maybe what's coming up, especially important if you're looking to get up to speed quickly on what's happening in the financial world.
Exactly. All right, kicking things off, let's look at the big economic headlines from this past week. What were the key data points we saw, the ones that really stood out?
Well, the main one was probably the final read on first quarter GDP growth. It actually came in lower than expected at minus 0.5%. That was a downward revision from the earlier forecast of minus 0.2%.
Okay, lower. Why the revision?
It was mostly because of a pretty significant downward revision in personal consumption spending. So people basically spent less than they first thought. But on the flip side, the Fed's preferred inflation measure, the PCE price index, that landed right in line with what everyone expected, up just 0.1%.
Okay, so GDP weaker, but inflation kind of behaving as expected. A bit of a mixed bag then.
Exactly.
So looking ahead to this week, what are the big economic reports we should be watching? What could, move the needle?
Right. Two key ones this week. On Tuesday, we get the ISM manufacturing report. Now, that's expected to be a little better than last month, but still below 50.
And below 50 means contraction, right?
That's right. Still signaling contraction in manufacturing. Then on Thursday, we get the big one, the jobs report. It's a day early because of the holiday on Friday, and the expectation there is for a slightly weaker report. Fewer jobs added, maybe a tick up in the unemployment rate compared to last month.
Okay, got it.
Yeah.
Now let's shift over to the Federal Reserve. Chairman Powell was testifying before Congress recently. He kind of dismissed recession worries, didn't he? Said the economy is still growing, despite that negative Q1 GDP.
He did. His quote was, "We are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy stance." And yeah, he pushed back pretty firmly against those members of Congress who were worried about a recession. He argued the underlying economy is still expanding.
Okay, but here's where it gets interesting, right? How did the markets react to Powell saying we can wait and those inline inflation numbers? Did it actually change what people expect the Fed to do?
This is fascinating because, yes, it really did. We saw a huge shift in market expectations for Fed rate cuts. After Powell's testimony and that PCE number, suddenly a big majority, 62%, are now expecting cuts of 75 basis points or more this year.
Wow, 62%. What was it before?
Just 43% the week before, so that's a considerable jump.
That is a big jump. So the market's basically saying, yeah, thanks, Jerome, but we think you're going to have to cut rates more aggressively.
Pretty much. It shows increased confidence or maybe hope for future easing. Investors seem more worried about growth slowing down than inflation right now. They're pricing in a more dovish Fed, even if Powell isn't explicitly saying that yet.
Okay, so with those economic signals and that market interpretation of Powell, how did the stock market actually perform? We've heard talk about record highs today, June 30th. What fueled that?
Yeah, that's right. Most parts of the U.S. stock market did hit record highs today. Small cap stocks were the main exception. We'll get to them. But the positive reaction was really driven by those increased expectations for Fed rate cuts, like we just talked about. Lower rates are generally good for stocks. Plus, it seems like worries about tariffs have kind of faded into the background for now, which reduces uncertainty.
So what were the numbers for the week?
Pretty strong across the board for the big guys. Large cap stocks were up 3.0%. Growth stocks did even better, up 3.9%. The Nasdaq gained 3.8%. Even small cap stocks managed a 2.0% gain for the week, and value stocks were up 1.7%.
And what about commodities, oil and gold?
They actually pulled back. Oil prices dropped 5.2% for the week, and gold fell 1.9%. Seems like the immediate Iran crisis concerns are easing off.
Right. So zooming out that, it's June 30th, mid-year point. How have U.S. stocks actually done overall in the first half of 2025, especially after that tariff scare earlier in the year?
Well, they've recovered remarkably well from that sell-off we saw back in early April. Remember that 12% drop after the Liberation Day tariff headlines?
Yeah, that spooked the market for a bit.
It did. But since then, they've climbed back and, like we said, hit record highs today. So for the year, different parts of the U.S. market are up somewhere between, say, 4.4% and 5.5%.
But you mentioned small caps are the exception.
Yeah, that's the key divergence you need to watch. Small cap stocks are still really struggling. They're actually down 2.5% so far in 2025, and they're still down a hefty 11% from their highway back in November 2021. It's been a multi-year struggle for them.
Interesting. Okay, what about outside the U.S.? How did global markets do this week, and what's the year-to-date picture look like compared to the U.S.?
Well, this past week, developed market stocks, excluding the U.S., were up 2.8%, and emerging markets gained 3.2%. So pretty similar moves to the U.S. for the week. The real standout globally, though, was Japan, up an impressive 5.6% just this week.
Wow, 5.6% in a week.
Yeah. Now, its market is still about 4% below the record it hit last summer, but it's bounced back strongly, up 30% from its lows back in early April this year.
Okay, and the bigger picture. First half of 2025, globally versus U.S.
This is where it gets really interesting. Year to date, both developed market and emerging market stocks are actually significantly outperforming U.S. stocks. Developed markets are up 18.2% for the year, and emerging markets are up 15.2%.
Whoa, that's way better than the 4-5% for the U.S. What's driving that huge difference?
A very large part of it is currency. The U.S. dollar has dropped about 11% in 2025.
Got it. You mentioned rates came down this week. What's the story for bonds this year overall? It feels like rates have been all over the place.
They really have. So bonds rallied last week too, yeah? The 10-year Treasury yield fell 9 basis points, closing at 4.23% today. That's investors betting more heavily on those Fed cuts. But yeah, looking at the year, rates have been volatile. The 10-year yield started 2025 just over 4.5%. Then it shot up really fast to 4.8% by mid-January. Then it fell pretty steadily through early April, even dipped just under 4% for a bit. Now it's closed today at 4.23%. So it's actually down 34 basis points for the year overall.
And commodities. You mentioned oil and gold pulled back this week, but year to date.
Well, gold has been the quiet star performer of 2025, really. It's up almost 26% for the year.
26%, nice.
Yeah, if you held gold, you're probably feeling pretty good. Oil, on the other hand, has been on a wild ride. It started the year falling sharply, down 19% through early May. Then came the Israel-Iran conflict fears, and boom, it shot up 31% between early May and June 20th.
And now it's falling again.
Right. Since June 20th, it's dropped back about 12% as those tensions seem to be easing. So yeah, very volatile.
Definitely. Okay, let's drill down to specific stocks now. Looking at the S&P 500 for the first half of the year, any huge winners or losers that tell us something interesting?
Yeah, if you look at the S&P 500 index for 2025, the biggest winner so far is NRG Energy. It's up a massive 76.3%.
Wow.
And the biggest loser, Deckers Outdoor, they're down 50.3%.
Ouch. So energy soaring, some consumer stock getting hammered. Is there a sector theme there?
Well, that's what's really interesting. When you look at the top 10 winners and the bottom 10 losers, there's no clear sector pattern. You've got utility stocks, tech, healthcare, materials, consumer names. They're scattered across both the winners and the losers lists.
So it's not like one sector is dominating everything.
Not at all. It really suggests that even with the overall market doing okay, performance is very much driven by company-specific things right now. You know, unique catalysts, individual stories.
So for you listening, it means maybe just betting on a whole sector isn't enough. You got to look deeper.
I think it's a fair takeaway, yeah. A more granular approach seems to be what's rewarded lately.
That's a really key point. And speaking of specific companies, what about the giants, the Magnificent Seven tech stocks? Are they still moving as one big block? How have they done this year?
No, not moving as a block at all, actually. We're seeing a really wide range of performance among those seven. That's Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla. Meta is actually leading the pack this year, up 23.5%.
Okay, and the laggard?
Tesla, it's Totem, down 26.3% for the year so far.
Big difference. And what about the very top, the biggest companies overall?
Well, that's where things have gotten really dynamic. You know, Apple was the biggest U.S. stock for most of last year, 2024, but Apple's actually down 19% in 2025. Meanwhile, Microsoft and NVIDIA are up 16.7% and 15.7% respectively.
So Apple's fallen behind them.
Yep. It's basically become a two-horse race for the top spot between Microsoft and NVIDIA. And actually, just recently, in late June, NVIDIA hit a new high and pulled ahead.
NVIDIA is number one now. Wow.
Yeah, and it's even getting kind of close to becoming the first ever $4 trillion company by market cap.
Incredible. Just shows how quickly things can shift, even among the giants.
Absolutely. Even within that dominant group, fortunes can change fast.
All right, so let's recap quickly. You should now have a much clearer picture of the recent market moves, what the Fed might be thinking, those key economic numbers, all distilled from this latest market outlook. Hopefully this deep dive gives you a real head start on understanding the current financial landscape.
Indeed. We've covered a lot. A market that's clearly reacting to potential Fed easing and shifting geopolitical winds. Some really remarkable individual stock stories, too, and those big global dynamics, especially with the dollar playing a role.
Definitely.
Thanks for joining us for this deep dive.